Hey guys, in this module, we're going to be taking a history lesson in exchanges and in ECNs. Now, we've already talked previously about market makers and how their job is to make a market for stocks. So buy at the bid, sell at the ask, but in the process, creating a market so if a seller or a buyer comes in, he has somebody to trade with. Now, since market makers have a main objective of actually making money for themselves, they weren't really doing the best job at it, because they would provide a market for the stock when they assumed that it was a good time for them to buy because the stock wasn't going to move. But when there was risk of movement, they would widen their bid and ask. So if the bid is $10 and the ask is 11, instead of if they think that the market isn't going to move, they might buy at 10, sell at 11, buy, sell. But the moment that they think the market might really move drastically, they're going to send their orders way further. So instead of buying at 10, they might put an order to buy at 8. So they're not actually going to be on the bid because there's risk for them. So they're not doing what they're really supposed to, which is make a market when we need a market for the product, but they're just trying to make money. Okay? And market makers were some of the richest people in the 80s. They were the rock stars of Wall Street. They made the most money just by buying and selling. Now, that job is completely abolished. It's been replaced by high-frequency traders. Market makers don't make as much money anymore, but they were the rock stars at their time. Now, there was a lot of things that the market makers and specialists were doing at the time that people didn't like. Basically, this is one of them, sending orders at really wide prices, not creating a market when you needed them. And there was a lot of delays on the exchanges. So when you send an order, sometimes the order was slow to get there. That led a man of the name of Jerome Pustinik. Actually, you can read about him in the book Dark Pools, I believe. Okay, which wanted to compete with the exchange. He wanted to create his own exchange. Okay, his own place of trading where there was no market makers and that was fully automated. So his idea was this. He was working at a big institution and he told himself this: institutions don't have to go to the exchange to trade. If you're a big institution, meaning a bank, a mutual fund, insurance company, well, you can do large block trades off the book. And then you got to disclose them to the exchange, but you can do them off the exchange, right? So he told himself this: if I have my computer here at my company, I know somebody at another hedge fund, I can connect it to his computer. And I know this other guy at another bank, we can connect it to his computer as well. And then this other guy here at this insurance company will connect it to him as well. And this other guy. So what he did is he connected all these big institutions together. So whenever one of them wanted to buy something, instead of sending their order to the exchange, to either New York Stock Exchange or NASDAQ, he can just post it here and they would trade with them instead of going to the market, right? And by doing that, he was going to pass the market makers. He wasn't going to trade with the market makers, and he would do it faster because his code, his connection was way faster. Okay, so that guy was a brainiac. He did that in 1967, and he called this an electronic communication network, which you can spell it out as ECN. So an ECN is an electronic communication network. So it's a network of computers that can communicate together. And by doing this, he actually created, and this we can call this NYSE, maybe this is New York Stock Exchange. He created his own book, right? Which he called INETs. INETs. Okay, Instanet. His company is called Instanet, and his ECN, he called it INET. So if you wanted to buy, you didn't necessarily need to put your order on New York. He could send it either on New York or on INET. Okay? So there was now, and I'll make this a little bit clearer, there wasn't, for big institutions, okay, because again, retail traders were not allowed to go trade there. If you're a retail trader, a regular person, you have to go to New York Stock Exchange if you want to buy or sell. But for institutions that could connect to his network, they were allowed to go buy shares on this new destination. on this new kind of exchange. It wasn't an exchange, but it was an ECN. So the problem with that is this. Do you guys think that somebody that had the option to go to New York, and let's call this New York, NYSE, you have buyers here, sellers here, right? Let's say $10, 11. But then you have this new place called INETs. Okay? And let's say here somebody wants to sell at 12, somebody wants to buy at 8. Do you guys think people started going there to send their orders there? Institutions? No, right? Why would they go there? There's nobody there, right? Again, imagine I tell you this, hey, there's this new social media platform called whatever, ABC. You should go open a profile on it. But none of your friends are on it. Nobody's on it. You're going to be the only one. Would you go there? No, because there's nobody on it. You need people to be already on it to want to go on it. So this is one of those markets that's the same thing as social media. If there's nobody on it, you're not going to go there. If everybody's on it, you're going to have to go there. You have no choice. So it's this thing that I call, well, it's this concept of liquidity breeds liquidity. When there's liquidity at that place, it's going to bring in more liquidity. Facebook has a lot of liquid profiles, so it's going to bring in more profiles. The more liquidity it has, the more it brings. But if it doesn't have liquidity, nobody's ever going to want to go there. And that was the problem with INET, right? All the institutions, even though they had access to it, they didn't want to send orders to that location. Because if somebody wants to buy a stock at $11, well, there's nobody here at 11. So they're just going to go here, right? So it didn't really work. Now, something happened at one point, and that was Black Monday. Okay? Black Monday happened in 1987. And on that day, the market crashed 22.6%. Okay, in one day. So in one day, the economy lost almost a quarter of its value, right? A quarter of the value just vanished. What happened on that day? People were calling their brokers, and the brokers weren't even answering the phone to sell the stocks of the people who wanted to sell because they didn't know what was going on. The market went silent for a bit and no trades were happening on the New York Stock Exchange and NASDAQ. And the market makers who were supposed to leave bids and offers and trade, they canceled their orders. They didn't want to trade, right? But what happened was trading continued happening on INET. Because on INET, it was all automated. It was computers. There was no market makers. So orders kept flowing in and traded with one another. So institutions started sending their orders there because there was trading happening at that place. Even though nobody was trading here anymore. Everybody disappeared. You know, there was no buyers. So that started bringing more people to INET. But it still wasn't enough. It still wasn't enough. It started getting a little bit of traction, but not a lot of people started going there. But another thing then happened. And that other thing happened in 1994 when two economists looked at the bids and the offers of all or a bunch of market makers, and they've realized that mathematically it was impossible for all these market makers to be sending their bids and offers at those same prices. So they realized that there was collusion between market makers, and that market makers were talking with each other to widen the spreads of the stocks as much as they can so they can make the most money possible, right? And they were making a lot of money. But it was mathematically impossible that all these market makers were setting their prices in that same fashion, right? It's like if all the grocery store in your province call each other and say, hey, let's hike the price of baby formula because we know people are going to have to buy it, so we'll just make more money. It's illegal. And that's what market makers were doing. They were widening the spreads to make the most money possible. So the studies that these economists make were, you know, they were undisputable, and they brought a lawsuit against NASDAQ. And in that lawsuit, the exchange NASDAQ had to settle, and part of that settlement was that they had to let ECNs like INET act like exchanges. And by acting like exchanges, meaning that regular investors could now go buy on INET if they wish to do so. Since we couldn't trust New York and Nasdaq anymore, well, we're also allowed to go buy on INET. So remember before when I told you, if you want to buy or sell a stock, you had to go to the store where you're allowed to buy it and sell it, like New York or Nasdaq. You can't go somewhere else. Well, on that day, you were allowed to go here and buy and sell stocks for something that was registered on New York or on Nasdaq. Okay? Now, that being said, a lot of people started going there, and you had a lot of buyers and sellers, and still a lot of people were here too. Now, as INET became super popular, other people wanted to do their own ECNs. And one of the biggest ECNs and one that revolutionized ECNs also is called ARCA. ARCA was developed in 1994 by Stuart Townsend. Again, you can read about them in Dark Pools, I believe, as well. First orders were in 1997, so that's not too far ago, right? That's 20 years ago that this revolution happened, because now ECNs, the majority of volume happens on different ECNs, not just on New York and Nasdaq. So that's not too far ago, okay? So what that guy came up with, when he came into that market and he wanted to compete with them, he told himself this: well, if I open my ECN and I call it, ARCA, which actually ARCA stands for Archipelago, which is a series of interconnected islands, right? Same thing with ECNs. Why would anybody want to come here? Why would buyers and sellers want to come to my ECN when there's these two big ones, right? And he started thinking, and he's like, you know what? I have an idea. What I'm going to do is I'm going to pay people who add liquidity on my ECN. Again, what does adding liquidity mean? Is being passive, sending an order to buy passively or sending an order to sell passively. I'm going to pay people because on these ECNs, New York would charge $1 per 1,000 shares. Regardless if you're adding or removing liquidity, you pay $1. INET, same thing, okay? So you pay $1 if you're buying or selling. So he said this: you know what? What I'm going to do is I'm going to give people $2. I'm going to pay them out of my pocket $2 if they add liquidity here. So if you have somebody buying here at 10, somebody buying here at 10, and let's say we had somebody here who wants to buy at 10. Well, if you buy at 10 here, you get charged $1. If you buy at 10 here, you get charged $1. But if you buy at 10 here, I give you $2. So guess what happened by him doing that? Everybody who wanted to buy stocks on these ECNs didn't want to buy stocks there anymore. They all canceled their orders and they went here because they knew here they were going to get paid. Okay? So all the liquidity started flowing from this exchange and this ECN to this new ECN. Now, how could ARCA afford to pay $2 for each person that added liquidity? By charging the people who removed liquidity from the market. So they came around and said, okay, well, you know what? I'm gonna charge $3 if you remove liquidity. That means if you want to sell aggressively or buy aggressively, you want to remove liquidity from the market, I'm actually gonna charge you $3. Now, you might think, okay, well, nobody's gonna want to remove liquidity from there. They're all gonna go here to remove liquidity. But no, you kind of have no choice but to remove liquidity from here because that's the only place that had liquidity at this moment. So if you want to sell right now the stock, where can you sell at? Well, here it might be 9, right? Where can you sell at? Can you sell here or here? No, because here there's buyers at 9. The buyers at 10, they're all here because everybody wants to be here because they're getting paid. So if you want to sell, the only place that you can sell at a good price is here. So you're kind of obliged to go here to remove liquidity because this is the only place that has liquidity. So you end up paying $3 to remove liquidity. People who added liquidity get $2. ARCA keeps the $1 in between. And then everybody, all the people who add liquidity, stop adding liquidity on these exchanges because they're getting charged here, and they prefer adding liquidity here, so they put all their orders here. Now, that was revolutionary, right? Because it brought all the liquidity to them, and it was the first ECN to come up with a pricing scheme like that. So guess what happened as soon as they did that? INET, New York, instantly copied their pricing scheme. They paid people to add liquidity, charged people to remove liquidity. So obviously they could not compete with that and had to do something like this. Now throughout time, more ECNs came to life, all with different pricing schemes. The problem with New York and NASDAQ is their matching algorithms, their matching systems weren't as good or efficient as these new ECNs. And ARCA and INET that were developed by extreme geeks that really love to do this had a perfect algorithm. You could have millions of orders come in and come out and execute with one another at extremely fast speeds. New York and NASDAQ had an outdated system that was still slow and that lagged by, again, a very small amount, but still it made an impact to these ECNs. So what happened? Obviously, NASDAQ and New York bought INET and ARCA. So NASDAQ in 2005 bought INET, New York bought ARCA in 2006. So again, 12 years ago, not that far off. So they bought them. So that's why if you go on New York's website, it's going to be New York ARCA, and NASDAQ has INET. Now, nowadays, there's, I'd say something in the range of 50 to 100 different ECNs that you can choose from, that you can buy and sell, electronic communication networks, okay? And every different ECN has different pricing schemes. Now, there's some notes with this module that has a fee structure for some of the current ECNs. And again, if you guys are trading with, let's say, Interactive Broker, you can see their list of ECNs as well. Some brokers, and I'm going to talk more about that in a video just about brokers, on which brokers permit you to use ECNs and which don't really give you that. It's going to be in one of the next modules. But in this module, there's going to be some notes about the fee structure of the ECNs that we use the most and that are the most popular, right? ARCA is still one of them up to this day. New York is there, NASDAQ, but then you have a few others like AJ, BATS, BYX, NSDQ Boston. So you have a bunch of different ECNs. I invite you to pause this video, look at the fee structures, and then come back. Okay, so if you've done that, you've realized that some of these ECNs actually pay you to add liquidity and charge you to remove, but some actually charge you to add liquidity. What is that about? Why would you actually go on an ECN that charges you to add liquidity, right? Because we've said, if it's $10 here and they're giving you money, and let's say, and again, for you to understand this better, now we don't have just this ECN, we have a bunch of them, right? We have here INETs, okay? So on INET, if somebody comes in and posts a bid at $10, 1,000 shares, when you actually look at the level 2 or the book, and where's my eraser? Here it is. If you look at the level 2 or the book of New York, you're not just seeing the prices on New York. You're seeing the prices that are on all the ECNs on the book of New York. So when somebody puts an order at $10, 1,000 shares on INET, INET has to tell New York about it. And New York has to put it here. And it has to say that this is from INET. Okay? So they're going to put an I next to it. Okay? And then if somebody puts, an order at $10 here on ARCA for, let's say, 5,000 shares, well, ARCA needs to tell New York, hey, I have also 5,000 shares at $10, okay? And then there's going to be a little A next to that order. So you don't have to go to each ECN to know what the bid and ask or the prices are on that ECN, because all these ECNs, and there might be another one here called BYX, okay? And maybe the person on BYX who wants to buy or sell, maybe they want to sell at $11, right? 1,000 shares. So BYX is going to tell New York, and New York is going to put the order here, $11, 1,000 shares, and there's going to be a little B next to it for BYX. So you don't have to go on each ECN to know what the prices are. All you have to do is go on New York, and New York is going to disclose all prices on all electronic communication networks and on New York itself, right? So this is all you got to do. Now, if you've looked at the fee schedule, you've realized that some companies, some ECNs actually charge you if you add liquidity. So let's say somebody wanted to buy at $10 on BYX, okay, $10, and he wants to buy 1,000 shares. His order is going to go here to New York, $10, 1,000 shares, okay? I was going to say BYX. So if you look at this fee schedule, you're going to see that the person on BYX, if you add liquidity on BYX, you are going to be charged how much BYX, if you're adding liquidity, $1.80. So you would be charged $1.80 if you add liquidity here, right? If you add liquidity on ARCA, you actually get $2. You get $2. If you're adding liquidity on, well, let's say this is BATS or for INET, you'll get $2 as well. So why would you go on BYX and get charged money when you can go on one of these and get money? Well, the answer is very, very simple. Okay, look at what's the fee for the other person. If somebody goes here, if you're a seller, you want to sell your shares right now. Okay, if you want to sell your shares right now, and at $10, you have a buyer on INET who wants to buy 1,000 shares, and another buyer on ARCA and one on BYX. Who would you want to go to as a seller? As somebody who's aggressively selling, you'd want to go to the person that gives you the most money. So, as somebody who's removing liquidity, if you look at the fee schedule, how much money would you get or pay if you go on INET, which let's say it's BATS? Well, this one you actually have to pay $3 if you're removing liquidity. And on ARCA, you'll also have to pay $3. So they have the same fee schedule. If you remove liquidity from BYX, what would be your cost? Oh, if you remove liquidity on BYX, you actually get paid $1.50 per 1,000 shares. So as somebody who wants to remove liquidity, somebody who wants to sell aggressively and sell right away, you're going to want to sell to the person on BYX, right? So that's why somebody would want to go on BYX. Because by going on BYX, even though he came after this guy who wanted to buy 1,000 shares and after this guy who wanted to buy 5,000 shares, he still got filled before them. Because he went on an ECN that gets served faster. And why does it get served faster? Because they get charged and they actually pay the person who is removing liquidity. So whenever somebody's aggressively removing liquidity, he's going to go to the ECN that pays them. And since that is the ECN that pays them the most, they're going to go there first. So if you really want to get that position fast, you want to buy right away, and you want to skip the line, skip the other people who want to buy, go on one of the ECNs that actually charges you. Yeah, you'll get paid $1.80 per 1,000 shares, but then you might get the fill. And if you're able to buy here and sell back here, well, you make $1,000, so you don't care about that $1.80, right? So that's why somebody would go on an ECN that actually charges them, because they want to get filled faster. Because the way you got to see it, and we've already talked about this, and actually we'll cover this right now. In the other video, I talked about NBBO, and I said how the NBBO is the same thing as the level 1, which I kind of lied. The NBBO, which is the National Best Bid and Offer, right? Why was that invented? Because we have different ECNs, okay? And if on one ECN, okay, and let's say there's this other ECN here, and on this ECN, the bid was $9, okay? I don't know if you can even see that. Well, you're not allowed to sell at $9 if on the other ECNs there's bids of $10. You have to trade within the national best bid and offer. And the national best bid and offer is the best bid available and the best offer available on any ECN/exchange in the nation, right? So if here there's somebody who wants to buy at $10, you're not allowed to go to sell to somebody who has a worst price like $9 or $8 somewhere else. He has to get filled first. But if it's within the same, so you can't select where you buy or where you sell because you gotta buy within the NBBO. But once you are within the NBBO, so now what's the national best bid and offer right now? It's $10 and $11. So the national best bid is $10. But there's 3 different stores, location, that have $10 on them. So now you actually have the choice to pick and choose. Do I want to buy or sell from this guy on INET or from BYX or for ARCA? You're allowed, right? Even if the guy on ARCA was there an hour earlier than the guy on BYX, you can sell to the guy on BYX. So even if they have the same price, again, we've already said it's price priority, then time priority. So if it's the same price, it should be by time priority. But now it's not even that, because if you go on another ECN, even if you came after this person, well, you're the first person on that ECN, right? So you could jump the line. So the way you gotta see it is each ECN is its own queue. It's its own waiting line, right? And you can go wait in whichever ECN pleases you. Some ECNs move slower than others, and some ECNs move really fast, right? It's basically like you going to McDonald's and wait, and there's a few lines. Some lines are very slow, but they might charge you less. Again, that's a stupid example. But there might be a super fast line, but costs you more, right? So you gotta think, what do I want? Do I want to get these fees, or do I want to, get charged something but get filled faster? Now, if it's an important position, we most often use ECNs that charge us, but we will get our positions faster. And I'll explain more on how to use ECNs in another video, and which brokers permit you to use ECNs and how to use them, and way more on that. It's actually a complex module here, and I hope you really got it. If you didn't, post in the comments and I'll answer all the questions you have. Now, there's also another example picture of a level 2, and on that example, you'll see that on each price, you have a bunch of different ECNs, and you'll see the names of the ECNs are exactly the same, and this is a picture that I put of what we trade right now, right? So it's all the same ECNs that you have in the fee schedule, and you can actually Google them and see, all the different fee schedule and all different ECNs and how they interact with one another. So that's really going to conclude this module, and we're going to build on top of this in the next module. So see you soon.